Welcome to the Deep Dive, the place where we turn complex financial codes into concrete, usable knowledge. Today, we are undertaking a pretty high-stakes investigation.
We certainly are.
We're looking into one of the most scrutinized areas of the Internal Revenue Code, transactions involving related parties.
Yeah, things like loans, sales, any financial choreography, really, between, family members, major shareholders, affiliated entities, sister companies, that sort of thing.
And the IRS treats these dealings with intense, almost institutional suspicion.
Well, that suspicion isn't arbitrary. It's rooted in decades of taxpayers finding, let's say, creative ways to game the system.
Right.
If you're transacting with yourself or someone you control, there's just a fundamental incentive to maybe manipulate income or accelerate favorable deductions or even generate losses that just wouldn't exist in a true arm's-length deal.
So our core mission today is what, exactly?
It's really to give you a detailed roadmap of how the government polices this behavior. We are diving deep into the specifics of the rulebook. We're talking IRC Section 267, which draws the line on who's related, all the way to Section 7872, which dictates interest rates, and even Section 469, which kind of solves the passive activity puzzle.
So our goal for you, the listener, is basically a total shortcut. We're providing the essential nuggets of knowledge, the rules of engagement, so you know exactly where the tripwires are located. We'll explore why the whole idea of an interest-free loan is, for tax purposes at least, a dangerous myth. And we'll detail the potentially catastrophic consequences of reclassifying debt as an unforeseen distribution.
And we're anchoring this knowledge with some fascinating real-world examples, including a really recent, highly unusual 2024 tax court decision. It's one where a taxpayer actually successfully argued against their own prior reporting and won a massive deduction.
That sounds like a story worth hearing. Okay, let's get started. Let's begin at the very beginning. Who exactly is considered related for tax purposes?
This definition is just foundational, right? It dictates whether these heightened scrutiny rules even apply. We're looking primarily at IRC Section 267 here.
Yeah, Section 267 draws a highly specific perimeter, actually much tighter than most people assume. It separates related parties into sort of two main buckets, family and business relationships.
Okay, let's start with family.
Right. On the family side, it's comprehensive but also extremely precise. Related parties include your spouse, your siblings, ancestors, so parents, grandparents, and your lineal descendants, meaning children and grandchildren.
That sounds pretty broad, but I think you mentioned the key insight here is often who is explicitly excluded.
That's the critical detail, often missed. Under this specific provision, Section 267, in-laws, so your spouse's family cousins, uncles, aunts, and crucially, former spouses, ex-wives, or ex-husbands. They're generally not considered related.
So if I do a deal with my brother-in-law, that relationship alone doesn't trigger these stringent Section 267 loss disallowance rules we'll talk about. Now, other rules might apply, but not this specific one based just on that relationship.
Okay. Moving to the business side, how does the code define relatedness between, say, entities and owners?
Generally, a corporation and any individual who owns, directly or indirectly, more than 50% of the stock value. They're related. That threshold is key.
More than 50.
More than 50%. It also applies to partnerships and partners who hold a significant interest. And importantly, we have to introduce the concept of constructive ownership.
Ah, right. What does that mean practically?
It means that when you're calculating that 50% ownership threshold, ownership can be attributed to you through family ties or entity control. So let's say your spouse owns 30% of a corporation and you own 25%.
Okay.
Well, under constructive ownership rules, your combined ownership is treated as 55%. That makes both you and the corporation related parties for these rules. The IRS essentially looks past the direct shareholder list to see who truly controls the enterprise.
Okay, so once we've established that two parties are related under Section 267, what happens when they sell or exchange property? This seems like the primary mechanism the law uses to prevent, artificial tax maneuvering.
Absolutely. The foundational rule here is loss disallowance. If you sell a piece of property to a related party at a loss, that loss is generally disallowed for tax purposes.
So I might sell it for $10,000 less than my basis, but I don't get that deduction.
Exactly. The IRS won't let you book that $10,000 tax deduction in that scenario. The law basically presumes you still have control or influence over the asset within that related group, so no true economic loss has been realized against the outside world yet.
But gains Gains are different.
Correct. Gains are recognized and taxed normally, so you can't use a sale to a related party to avoid paying tax on a gain only to create a loss that the IRS might disallow.
Okay. But you mentioned the tax code isn't entirely punitive about these disallowed losses. There's some relief.
That's right. The original disallowed loss isn't just gone forever. It's sort of suspended. It carries forward and provides potential relief, but only when the related buyer eventually sells that asset to an unrelated third party.
Ah, okay. Walk us through that practical example you mentioned, the suspended loss one.
Okay, let's say an individual owns two corporations. We'll call them Brother Co. and Sister Co. Brother Co. sells a machine to Sister Co. for $7,000. But Brother Co.'s basis in that machine was $10,000.
So a $3,000 loss.
Right, a $3,000 disallowed loss for Brother Co. Now, Sister Co.'s basis in the machine is just the $7,000 it paid. Okay, fast forward 2 years, Sister Co. sells that same machine to a totally unrelated customer for $9,000.
So Sister Co. has a $2,000 gain, $9,000 sale price minus its $7,000 basis.
Exactly. Now, that original $3,000 disallowed loss that Brother Co. couldn't take, it can be used by Sister Co. to offset its $2,000 gain.
Oh, interesting. So it wipes out the gain.
It does. It reduces Sister Co.'s taxable gain down to zero. In effect, that $3,000 suspended loss acted like a basis adjustment, but only for gain recognition purposes on that second sale.
What if Sister Co. sold it for less, say $5,000, another loss?
Ah, good question. In that case, if Sister Co. sells it for $5,000, resulting in another loss, that original $3,000 suspended loss from Brother Co., it's permanently forfeited, gone. You can't use the suspended loss to create or increase a new loss. It only offsets subsequent gain.
Got it. Okay, and before we move on from sales, there's a special rule for depreciable property, Section 1239.
Yes, this is a classic anti-abuse rule. Section 1239 basically says that any gain recognized on the sale of property that is depreciable in the hands of the buyer, and the sale is between related parties, that gain must be taxed as ordinary income, not as preferential capital gain.
So what's the abuse they're stopping there?
Well, the taxpayer's goal is usually to sell a fully depreciated asset, maybe with a zero basis, to a related entity at a high price. They'd hope to recognize a capital gain.
Which is taxed at lower rates.
Exactly. And then the related entity gets to restart depreciation deductions on that new high basis. Section 1239 stops this conversion of ordinary depreciation recapture back into capital gain dead in its tracks. It forces the gain back into ordinary income, negating that primary tax benefit.
All right, now let's shift our focus from sales to the often ignored yet highly perilous world of related party loans. This is governed by IRC Section 7872, and we need to appreciate the context here. This rule wasn't created recently. It came about in 1984. Why was that year so pivotal?
Well, 1984, specifically the Deficit Reduction Act, was really a reaction to the economic reality of the time. Interest rates were incredibly high back then, often well over 10%, sometimes much higher.
Wow.
Before Section 872, an owner, say, of a C corporation could take a massive, completely interest-free loan from their company. It was essentially a tax-free way to extract cash, a benefit very similar to a dividend, but because it was documented as a loan, no income was recognized by the owner.
So Congress saw this as a huge loophole.
A massive leakage of taxable income. Section 7872 slammed that door shut by establishing the concept of imputed interest for what they called below-market loans.
And the benchmark for compliance there is the applicable federal rate, the AFR, the one the IRS publishes monthly.
That's the one. If the loan's stated interest rate is lower than the relevant AFR, the difference is called the foregone interest, and that's what the IRS essentially forces you to recognize.
Okay, and the mechanism they use to tax this foregone interest, it's critical, right? It's treated as a two-parter or deemed transaction.
Exactly. This is the core engine of Section 7872. It's crucial to understand how this works because it determines the actual tax impact.
Okay, let's meticulously unpack that two-part deemed transaction.
So the transaction is treated as occurring simultaneously in two stages. Stage one, there's a deemed transfer of that foregone interest from the lender to the borrower.
Okay.
Now, the character of this transfer depends entirely on the relationship between the parties. For example, if a company loans money interest-free to its owner.
Like the old C Corp example.
Right. That foregone interest is deemed to be a corporate dividend paid to the shareholder. If an employer loans money interest-free to an employee, it's deemed compensation. If a parent loans money interest-free to a child, it's deemed a gift.
Okay, that's stage one. What's stage two?
Immediately following stage one, there's a corresponding deemed interest payment from the borrower back to the lender.
Ah, so the system forces income recognition on both sides. But the type of income and deduction is radically different depending on what happened in Stage 1.
Precisely. It's all about the characterization. If that Stage 1 transfer was characterized as a dividend, corporation to shareholder, well, the corporation gets no deduction for that deemed payment, but the shareholder has taxable dividend income. If it's compensation, employer to employee, the employer gets a deduction for compensation expense, and the employee has taxable wage income. Only when it's characterized as simple interest, like maybe in a family loan situation, does it potentially follow the standard interest income interest expense structure. But the key is, regardless of the characterization, the cash flow is zero in these deemed steps, but the tax obligations are very real.
We've established the penalty for noncompliance, the imputed interest. But are there any small pockets of relief? Let's look at the de minimis exceptions.
Yes, thankfully relief exists primarily for small loans. The first big one is the $10,000 exception. Basically, if the total aggregate outstanding loan amount between the related parties is $10,000 or less, the imputed interest rules generally do not apply.
That seems critical for small businesses making, minor short-term advances.
It is, but like everything in tax, even that simple $10,000 exception has a complex caveat.
Of course it does. What's the catch?
The exception is completely voided if the principal purpose of the loan is tax avoidance. Or, more commonly, if the loan proceeds are used by the borrower to purchase or carry income-producing assets.
So if I loan my brother $9,000 interest-free, and he uses it to buy some stock or a piece of rental real estate,
then the $10,000 exception is automatically lost. Imputed interest applies even below that threshold in that case.
Okay. What about larger but still personal gift loans, say between family members?
For gift loans under $100,000, there's another crucial limitation. It's tied to the borrower's net investment income, or NII.
Okay.
The imputed interest in this scenario is capped at the borrower's NII for the year. And here's the really helpful part. If the borrower's NII is $1,000 or less for that year, the imputed interest is treated as zero.
So that protects recipients of maybe modest family loans who aren't generating significant investment income themselves.
Exactly. It avoids penalizing someone who receives, say, a $50,000 interest-free loan from a parent to help with the down payment if that recipient doesn't have much investment income otherwise. IRC Section 267.
Okay, well, those exceptions offer some clear relief. They also remind us that when we do cross those thresholds, the rules don't just ask how much interest to impute. They also ask that trickier question. When do we recognize it? And that brings us to what you call the Byzantine interaction of Section 267 and Section 7872.
Byzantine is a good word for it. This is really a battle between older and newer tax law. Section 267, the older rule, was created specifically to solve what was called the timing mismatch problem.
Right. Explain that again quickly.
Before 7872 existed, you could have an accrual method business, which deducts expenses when they are incurred, not necessarily when paid accrue and deduct interest expense owed to its owner, who might be using the cash method.
And the cash method owner wouldn't report the income until the interest was actually paid, which could be years later or never.
Exactly. So the business got an immediate deduction, but there was no corresponding income recognition for the owner, a big timing advantage.
So the original Section 267 solution was basically to force the accrual business onto the cash method for that specific expense. They couldn't deduct it until the related cash method party recognized the income.
That's precisely what Section 267A2. It matched the timing by delaying the deduction. But then came Section 872 in 1984. By deeming the foregone interest as if it were paid annually, Section 872 effectively introduced a concept known as original issue discount, or OID, into these related party loans.
Okay, OID. For the listener, what's the simple version of OID in this context?
OID is basically a mechanism that forces the lender, the related party receiving the interest, to treat that foregone interest as if it were baked into the principal from the very beginning. It requires the lender to recognize that interest income annually, regardless of whether cash actually changed hands.
Okay. There's a Section 7872. Through this OID mechanism, forces the cash method lender to recognize income annually, even if it's unpaid. How does that resolve the conflict with the older Section 267 timing rule?
Well, since Section 872 mandates annual income recognition for the lender via OID, The condition in Section 267(a)(2 that the income must be recognized for the deduction to be allowed is now automatically met each year.
So the accrual method borrower is now permitted to take the corresponding deduction annually, matching the lender's mandated income recognition.
Exactly. Section 7872 essentially overrides the timing restriction of Section 667 by forcing the income inclusion first. It achieves the intended legislative goal of aligning the deduction and income timing, but through a different, more complex mechanism.
But wait, the rules get tangled again if both the owner and the business are cash method taxpayers and the interest is just accrued on the books but not actually paid.
Yes, the cash problem. This is a tricky one. In this scenario, the cash method lender is still forced by Section 872 and the OID rules to recognize the mandated interest income annually.
Even with no cash received.
Correct. But because the borrower is also a cash method taxpayer, the borrower generally cannot deduct the interest expense until they actually pay the cash.
So the lender recognizes income, but the borrower's deduction is delayed.
The income is recognized by the lender, potentially creating phantom income tax liability, but the corresponding tax relief for the borrower via the deduction is delayed, possibly indefinitely, if payment never actually occurs.
This sounds like an absolute accounting nightmare. It must lead to inevitable differences in the loan's basis on the company's books versus the owner's personal tax records.
It creates a tremendous administrative burden. You have to track basis differences carefully. Imagine an accrual method business accrues, say, 5% interest annually for its internal book purposes, because that's what the note says. But maybe the AFR rate for tax purposes under Section 872 is only 1% that year. The debt basis for the borrower increases by 5% on their internal books. But the tax basis of that debt only increases by the 1% OID amount mandated by Section 872. And for the cash method lender, who's forced to recognize that 1% OID income, their tax basis in the debt also increases by 1%, even though they received no cash.
So you have different book and tax bases floating around for both parties.
Exactly. These discrepancies have to be meticulously tracked, often using specific tax forms for OID adjustments, and then reconciled upon final repayment, restructuring, or if the debt is ever forgiven. It's complex.
Okay, let's pivot now to pass-through entities, specifically LLCs taxed as partnerships. When a member loans money to the LLC, the stakes seem very high. This isn't just about interest rates anymore. It's about the fundamental nature of the investment. Is it really debt, or is it just disguised equity, a capital contribution?
That distinction is absolutely crucial, primarily because it dictates loss deductibility for the member. A capital contribution increases the member's basis in their LLC interest dollar for dollar, right? That gives them immediate capacity to deduct potentially larger pass-through losses from the LLC.
Whereas a loan
only increases a member's basis indirectly through the liability sharing rules under Section 752. Now, it's true that a loan from a member or an affiliate is typically allocated 100% to that specific lending member for basis purposes under those rules. But the IRS is acutely aware of the temptation to structure what should be an equity infusion as debt, simply to allow the member to pull cash out later, tax-free, as a loan repayment instead of a potentially taxable distribution.
So what does a member need to do to satisfy the IRS that their transaction is, in fact, a bona fide loan? Something that mirrors what they do with an unrelated bank.
You absolutely have to satisfy the Bona Fide Debt Test that we see coming up repeatedly in case law, like in the PK Ventures case. Documentation has to be rigorous, it can't be casual.
What does that mean specifically?
It means executing a formal, legally enforceable promissory note. It needs a fixed maturity date, or at least clear repayment terms. It needs adequate stated interest. You can't just ignore the AFR rules we just discussed. It shouldn't just be scribbled in the meeting minutes.
And beyond the note itself.
We also look for evidence of commercial reasonableness in the terms. Does the lender have the right to seek a security interest? Actually, having a secured interest is strongly recommended. Are there requirements for personal guarantees from other owners, perhaps? Does the note include clauses covering the lender's right to attorney's fees upon default, or waiver of demand? Basically, if you treat the advance like equity internally, the IRS will likely tax it as equity externally.
Okay, let's look at a concrete example of doing it right.
All right, take example 1 from the outline. D is a 25% member in PLLC. D loans the LLC $100,000. They use a properly signed secured demand note. It calls for interest at the current AFR, payable quarterly.
And how is it reported?
Critically, D reports the interest income directly on their individual tax return, Form 1040, not as some allocation on the K-1. And the LLC takes the corresponding interest deduction as a trade or business expense on its partnership return. Because they treated it formally, respecting the debtor-creditor relationship, the IRS is much more likely to respect it as debt, preserving the flexibility of repayment for D down the road.
Okay, now let's flip the direction. What if the LLC loans money to one of its members? What's the core risk the member faces in that scenario?
The primary risk there is that the IRS recharacterizes the transfer as a distribution. If the member can't demonstrate a credible intention and, importantly, the ability to repay the loan, the IRS will argue the funds were simply profits being taken out of the company.
And the consequence of that?
If that recharacterized distribution exceeds the member's tax basis in their LLC interest at that time, they suddenly realize taxable capital gain, often years before they ever planned to sell their interest or expected a tax hit.
So, again, documentation is paramount. Promissory notes, commercial terms, maybe even evidence of prompt payment of interest.
Absolutely. All the same factors apply. And when traditional collateral isn't readily available for the member to pledge, we sometimes look to alternatives, like building a right of set-off into the loan agreement.
What's that?
A right of set-off clause basically allows the LLC to withhold any future cash distributions or even capital contributions otherwise allocable to that borrowing member if they default on the loan. It acts as a sort of internal collateral, strengthening the argument that this was a real loan, not just an advance on future distributions.
That's clever. And we also have to remind listeners about the danger of later cancellation, right?
Yes, definitely. If an LLC later decides to just forgive or cancel that loan balance owed by the member, that act of cancellation is treated immediately for tax purposes as a taxable distribution of money to the member at the time of cancellation. It doesn't just disappear. IRC Section 469-7.
Okay, this next part takes us into, well, the heart of complexity. The passive activity loss, or POL, rules, and how they interact with these member loans via the self-charged interest provisions under IRC Section 469. If you loan money to your own passive activity, the tax result seems profoundly counterintuitive without these special rules.
It really is. The issue is a fundamental conflict in how income and expenses are classified under the PLO rules.
Yeah.
When a member loans money to their LLC and that LLC uses the funds in a passive activity, let's say a large rental property portfolio, the member receives interest income from the LLC. That interest income is generally classified as desirable portfolio income. Think interest, dividends, capital gains.
Right, but simultaneously.
Simultaneously, the LLC generates an interest expense from paying that interest, which is passed through to the member on their K-1s. Since the LLC activity is passive, that interest expense is classified as a passive loss for the member.
And here's the kicker. The general PLO rules prevent you from offsetting portfolio income with passive losses, correct?
That's the trap. So without a special rule, the taxpayer ends up paying tax on the portfolio interest income they received, while the related passive interest expense deduction they were allocated remains suspended and unusable, possibly for years. It's fundamentally unfair when the taxpayer is essentially transacting with their own entity.
So Congress recognized this inequity. What's the fix?
The solution is found in the regulations under Section 469-7, known as the self-charged interest rules. These rules essentially allow the taxpayer to recharacterize a portion or sometimes all of that portfolio interest income they received into passive income.
Allowing it to be directly offset by the related passive interest expense from the same activity.
Precisely. It's an administrative fix designed specifically to prevent this illogical mismatch when a taxpayer is effectively paying interest to themselves through their pass-through entity.
Okay, let's try to break down the technical calculation. Maybe focus less on reciting the full formula and more on the principle behind the result. We need to see how the system reacts when a member loans more versus when they loan less than their proportional share of the LLC's borrowing.
Good approach. Let's start with example 2. J and G are 50-50 members in a passive LLC. J loans the LLC $50,000, but G loans $0. J receives $5,000 in interest income portfolio. Because they are 50-50 members, J is allocated $2,500 of the LLC's passive interest expense.
Okay, so J loaned 100% of the money but only got 50% of the expense allocation. How much income can J recharacterize as passive?
J calculates his recharacterized passive income using a specific fraction. He takes his interest income, $5,000, and multiplies it by his share of the passive interest expense, $2,500, divided by the greater of either his expense share, $2,500, or his total interest income received from that activity, $5,000.
Okay, so the denominator is the greater of $2,500 or $5,000, which is $5,000. So 5,000 times 2,500, $5,000.
Right, which equals $2,500. So J gets to recharacterize $2,500 of his $5,000 interest income as passive.
And notice, $2,500 is exactly the amount of his passive loss allocation.
That's the key insight. He only gets to recharacterize an amount equal to his passive loss allocation in this case. The remaining $2,500 of his interest income stays portfolio income, fully taxable.
Wait, so let me make sure I grasp the core principle here. It seems like the system is designed to give maximum passive relief when you, the member, loan less than your proportional share. It almost rewards the one who wasn't primarily responsible for funding that specific loan. When you loan more, like Jay did here, you only get to recharacterize enough income to cover your own resulting loss allocation. Is that right?
That is precisely the principle embedded in the formula. The regulations are structured to prevent the member who overfunded the loan from converting additional portfolio income to passive status beyond what's needed to offset their share of the resulting passive deduction. It prevents an unintended windfall.
Okay, let's test that principle with example 3, where a member loans less than their share. E and P are equal 50-50 members in our LLC, another passive activity. E loans only $10,000, receiving $1,000 income, while P loans $20,000, receiving $2,000 income. The total interest expense is $3,000, so they each get allocated $1,500 of passive interest expense.
Okay, focus on E, who loaned less than her 50% share of the total $30 borrowing. E runs her calculation. Her interest income, $1,000, is multiplied by her expense share, $1,500, divided by the greater of her expense share, $1,500, or her income received, $1,000.
So the denominator here is the greater amount, $1,500.
Yeah.
Calculation, $1,000 times $1,500.
Which equals $1,000. E gets to recharacterize 100% of her interest income as passive. The formula provided maximum relief because her income, $1,000, was less than her allocated expense, $1,500.
And P, who loaned more than her share in that same example, what happens with her?
P follows the same structure. Her interest income, $2,000, is multiplied by her expense share, $1,500, divided by the greater of her expense share, $1,500, or her income received, $2,000.
Okay, the denominator for P is $2,000. So $2,000, $1,500 to $2,000.
Which equals $1,500. P recharacterizes $1,500 of her $2,000 income as passive. That's 75% of her income. And notice again, $1,500 is exactly the amount needed to offset her passive expense allocation. The formula successfully navigates the proportionality issue to achieve fairness in both scenarios.
Wow. Okay, I think we all just earned a degree in remedial fractions and advanced tax law simultaneously there. If you're driving right now, please do not attempt to reverse engineer those self-charged ratios in your head. This is absolutely the definition of a call your tax advisor immediately moment, purely for the administrative complexity involved.
Agreed. It's calculation intensive. And we have one final crucial scenario in the self-charge section. What happens when the loan goes the other way? From the LLC to the member.
Right. Example 4. J borrows $30,000 from ULLC. J pays $3,000 in interest to the LLC. J uses half of that borrowed money passively, say in a rental property he owns personally, and half personally non-deductible. J and N are equal 50-50 members in ULLC, so they each get allocated $1,500 of the LLC's interest income, which came from the $3,000 J paid.
Okay. J's passive interest deduction resulting from this borrowing is $1,500. That's 50% of the $3,000 total interest he paid relating to the passive use. The self-charged rules allow J to recharacterize his share of the LLC's income, $1,500, based on the percentage of the loan he used passively.
How does the calculation work there?
J multiplies his share of the LLC's income, $1,500, by his passive interest deduction paid to the LLC, $1,500, and divides that by the greater of his total interest deduction paid to the LLC, $3,000, both passive and personal portions, or his share of the LLC's income, $1,500.
So the denominator is the greater of $3,000 or $1,500, which is $3,000.
Yeah.
Calculation. $1,500 times $1,500, $3,000.
Which equals $750, which is 50% of his $1,500 share of the LLC income as passive. This passive income perfectly offsets the $750 passive interest expense deduction generated from his passive use of half the loan proceeds. Again, the rules align income and expense related to the passive portion.
Okay, quick hits on related complexities. We have to briefly address the net investment income tax, the NIT, under Section 1411. Since this self-charged interest gets recharacterized as passive income, does that automatically subject it to the extra 3.8% IIT?
That's a great question, and fortunately, the regulations provide specific relief here. Self-charged interest income is only subject to the NIIT if it results in a reduction of income that would otherwise be subject to self-employment tax.
Okay, that's a subtle but really important distinction. It seems to depend on the entity type and the member status.
Exactly. So S corporation shareholders and limited partners who generally aren't subject to self-employment tax on their distributions or allocated income are typically safe from the NIIT on this specific recharacterized self-charged interest income.
That's a key takeaway.
It is. Conversely, general partners or LLC members treated as general partners for self-employment tax purposes or potentially C Corp shareholders receiving constructive dividends. They are more likely to find this recharacterized income is subject to the NIIT. This is definitely a planning consideration when choosing entity structures.
Okay. And finally, what if the member does a back-to-back loan? They borrow money from a third-party bank and then turn around and lend that exact money to their LLC.
The principle of fairness, of matching income and expense, extends here too. The member can potentially recharacterize the interest expense they pay to the third-party bank as passive, but only if and to the extent that the LLC uses those borrowed funds in its own passive activity.
And they use the same complex calculation percentage we just tortured ourselves with.
Yes, the same allocation percentage derived from the self-charged income calculation is used to determine how much of that third-party interest expense can be recharacterized as passive and used to offset other passive income.
We have spent a lot of time talking about compliance, documentation, interest rates. Now let's look at the dark side. What happens when the documentation is ignored? Interest is never charged or paid. Maybe the repayment terms are routinely violated. This is where the loan gets recharacterized, right? And the consequences can be financially devastating.
Recharacterization really is the nuclear option in this area.
Yep.
The IRS essentially views the transaction as a sham loan in name only, and they reclassify it. Often it's reclassified as a constructive dividend if it's coming out of a corporation, or potentially as a capital contribution if it's an early-stage infusion that lacked debt characteristics. The lack of documentation basically destroys the taxpayer's defense that a real bona fide debtor-creditor relationship ever existed.
And the consequences, particularly for corporations, seem frighteningly complex.
Oh, they're massive, especially for S corporations. For a C corporation, reclassification is usually a pretty straightforward taxable dividend for the shareholder. It's taxed at either ordinary or qualified dividend rates, but it's relatively predictable.
But for an S-corp,
For an S corporation, the risks just multiply. First, it can create a taxable distribution if the amount of the deemed dividend exceeds the shareholder's stock basis or the company's accumulated adjustments account. But even worse, if that loan was only given to one specific shareholder and not others proportionally. It can be deemed a disproportionate distribution. This violates the fundamental one class of stock rule required for S corporations, and the penalty for that, it can lead to the outright disqualification of the S election entirely, potentially subjecting the company to C corporation tax rates going forward, maybe even retroactively. A disaster.
Okay, one of the highest risk scenarios seems to involve loans between related brother-sister corporations, say, two S corporations owned by the same individual or group. You mentioned the courts apply a very strict two-prong test to decide if these are really constructive dividends in disguise.
That's right. It's typically analyzed as a sequence of elimination. Prong 1. The court first asks, did a bona fide debtor-creditor relationship actually exist between the two companies? They'll look at intent, documentation, enforcement actions, history of repayment, all those factors we discussed.
Yeah.
If the taxpayer can't prove a true debt existed, they fail prong 1 and the court moves to prong 2.
Okay, what's prong 2?
Prong 2. If it wasn't bona fide debt, the court then asks, was the transaction made primarily for the benefit of the common shareholder rather than for a legitimate corporate business purpose of the lending corporation?
That seems tough to overcome because the common shareholder is almost always involved in orchestrating these transfers. Proving the corporate benefit to the lender must be incredibly difficult.
It often is. The lending company is usually giving up cash with little prospect of return. So if the transaction was not bona fide debt, prong 1 failed, and it was primarily for the shareholder's personal benefit, not the lender's corporate benefit, prong 2 met, then the transfer is reclassified. It's typically treated as a constructive dividend from the lending corporation to the common shareholder, followed immediately by a deemed capital contribution from that shareholder to the borrowing corporation. It reroutes the transaction through the shareholder's hands for tax purposes. Hashtag tag 4.3, classic examples of recharacterization.
Let's illustrate this test failing with that Wilkoff case you mentioned from 1978. What happened there?
Right, Wilkoff. It involved two brothers who owned two companies, WSS and TWM. WSS was the profitable one, TWM was struggling. WSS transferred about $420,000 to TWM, essentially to help TWM repay its external bank loans. On the books, it was just recorded as an account receivable for WSS and an account payable for TWM. Very informal.
So it failed prong one almost immediately, right? Lack of debt characteristics.
Spectacularly. The court pointed out there was zero documentation. No promissory note, no fixed maturity date, no interest ever charged or paid, no collateral pledged, and no formal demand for repayment ever made, even when TWM continued to struggle. It was a complete absence of the formal indicia of debt.
Okay, prong one failed. What about prong two, the shareholder benefit?
The court found that WSS, the lending company, had absolutely no corporate business purpose for making these transfers. Its money was tied up with a highly questionable debtor with basically no enforcement mechanism for repayment. The benefit, the court concluded, flowed entirely to the common shareholders, the brothers.
How so?
They essentially used the assets of one of their companies, WSS, to prop up the equity value of their other company, TWM. This avoided them having to use their personal funds to rescue TWM, and it also relieved them of their personal guarantees on TWM's bank debt. So failure on both prongs resulted in the full $420,000 being reclassified as a taxable constructive dividend to the brothers.
Wow. Okay, and the Macklemore case from 1973 sounds like an even more blatant example, using intercompany debt as a personal ATM.
Yeah, Macklemore is pretty clear-cut. The common shareholder, Macklemore, owned Realty, a landlord, and Motors, the tenant. Macklemore personally needed cash to pay off a personal bank loan, so he orchestrated this series of transactions. Realty borrowed some money, then immediately lent $60,000 of it to Motors. Motors then immediately paid that same $60,000 directly to Macklemore. Macklemore then used that cash to pay off his personal bank loan.
So the loan from Realty to Motors was just a conduit to get cash from Realty to Macklemore personally, bypassing dividend treatment.
Precisely. The court just saw right through it. They dismissed the corporate argument that Realty was just trying to help its tenant, Motors. The court said the whole arrangement was designed purely to benefit Macklemore by allowing him to extract cash from Realty tax-free. They concluded it was a device, not debt, and the $60,000 transfer was simply a constructive dividend to the shareholder, Macklemore.
Okay, now we arrive at this remarkable 2024 case, Estate of Fry. You said this is the ultimate example of the debt versus equity distinction, but with a huge twist. The taxpayer actually won by arguing against his own company's records. This sounds fascinating.
It really is a unique one. So Thomas Fry owned two S corporations, Crown, which was a profitable trash collector, and CR Maintenance, which was a trash processor. They were fundamentally reliant on each other in an integrated business unit.
Okay.
Things went south when CR Maintenance lost a critical contract. It started racking up huge annual losses, somewhere between $5 and $7 million per year. To keep CR Maintenance afloat, Crown, the profitable sister company, systematically transferred funds to it and also paid many of CR Maintenance's creditors directly.
How much money are we talking?
Over the years, it totaled about $36 million. And crucially, on the company's internal books and tax returns, they simply recorded these transfers as liabilities or intercompany payables receivables. Very informal.
So where did the tax problem arise?
It came to a head in 2013. CR Maintenance had a massive $5.6 million loss pass through that year. Fry, as the S-Corp shareholder, wanted to deduct that loss on his personal return. But to deduct S-Corp losses, you need adequate basis in your stock and debt. His stock basis in CR Maintenance was tiny, only about $2,400.
Nowhere near enough to cover a $5.6 million loss.
Exactly. So the IRS correctly disallowed about $3.4 million of the losses Fry claimed, purely for lack of basis. Fry's entire case then hinged on the tax character of those $36 million in undocumented transfers from Crown. If they were truly dead as recorded, they wouldn't increase his stock basis in CR Maintenance significantly, and most of the loss deduction would be lost forever.
Okay, here's where it gets really interesting, as you said. Fry's estate, after he passed away, took a huge calculated risk. They argued that the very lack of documentation, the informality, it actually proved those transfers were not debt. Instead, they argued the transfers were, in substance, constructive dividends from Crown, the lending escort, to Thomas Fry personally, followed immediately by a deemed capital contribution from Fry to CR Maintenance, the borrowing S-Corp. Is that right? They argued for constructive dividend treatment.
That's exactly the argument they made. It was a strategic masterstroke, really turning the tables on the usual IRS position.
Why would they want that recharacterization?
Think about the basis impact. By recharacterizing the $36 million transfer through Fry as a capital contribution from him to CR Maintenance, He was essentially injecting $36 million of stock basis directly into CR maintenance.
Yeah, giving him the basis he desperately needed for the loss deduction.
Precisely. And since Fry already had very high bases in his Crown stock, the profitable company, the first leg of the recharacterization, the deemed dividend from Crown, was largely treated as a tax-free return of capital to him, not taxable income. So the recharacterization potentially created massive stock basis in CR maintenance at little or no immediate tax cost from the Crown side, allowing him to deduct the full $4.7 million in losses he had claimed from CR maintenance.
How did the IRS respond? They must have argued Fry was stuck with how his own companies reported the transfers as liabilities, right? Didn't they cite that Section 385C rule about being bound by your form?
They absolutely did argue that Fry was bound by his company's debt classification under IRC Section 385C, but the tax court actually disagreed with the IRS on this point.
Really? Why?
The court stated that Section 385C only binds a taxpayer to their chosen form if there was a formal issuance of a debt instrument, think a bond, a formal promissory note, or other written evidence of indebtedness. Since Crown and CR Maintenance had absolutely zero formal documentation for these $36 million transfers.
Just book entry.
Right, just book entries. The court decided Section 385C was simply irrelevant in this case because no formal instrument was ever issued.
Wow. So that opened the door for Fry's estate to argue substance over form, a doctrine usually wielded by the IRS, not the taxpayer.
Exactly. The court, somewhat surprisingly, allowed the taxpayer to argue that the economic substance of the transactions should prevail over the admittedly inconsistent form reported on the books. They cited precedent that the actual intent of the parties matters, especially when the form is ambiguous or contradicts the reality.
So how did the court analyze the substance? Did they use that debt versus equity factor test?
Yes. They performed the required analysis, applying the well-established multi-factor test to determine if the transfers looked more like debt or equity. In the Ninth Circuit, where this case could be appealed, these are known as the hardman factors. There were 11 of them.
And how did those 11 factors break down for the $36 million in transfers in Fry?
It was pretty decisive. The court found that 6 of the factors strongly favored equity. This included the complete lack of a fixed maturity date or repayment schedule, the fact that repayment was entirely dependent on CR maintenance somehow becoming profitable again, which was unlikely, the fact that no formal demand for payment was ever made, the advances were roughly proportional to Fry's ownership interest, and critically, the absence of any notes or formal debt instruments.
What about the other factors?
Only one factor slightly favored debt, the party's nominal classification on the books, which the court gave little weight, and 4 factors were deemed neutral. So the overwhelming conclusion based on the substance: these transfers were not bona fide debt. Prong 1 of the constructive dividend test, lack of bona fide debt, was met.
Okay, so it wasn't debt. Now, the final hurdle for Fry's estate, proving the primary benefit flowed to Fry, the shareholder, to satisfy prong 2 of the constructive dividend test.
The court addressed this too. It found that Crown, the lending S-corp, had no discernible independent corporate business purpose for making these massive, unsecured, non-interest-bearing advances. It received no benefit, it just poured money into a failing sister company.
So the benefit must have flowed to Fry.
Yes, the court concluded the primary benefit flowed directly to Fry. The transfers allowed him to keep his integrated trash business operating as a whole, avoiding the need to either shut down CR maintenance or infuse $36 million of his own personal wealth to cover its losses. Therefore, prong 2 was also met.
And the result?
The court upheld Fry's unconventional argument completely. The $36 million in transfers were recharacterized for tax purposes as constructive dividends from Crown to Fry, immediately followed by capital contributions from Fry to CR maintenance. This gave Fry the enormous increase in stock basis he needed, and the tax court allowed him to deduct the full disputed loss amount, a major win for the taxpayer, achieved by arguing against their own prior reporting.
Okay, let's unpack this Fry case. It's a truly remarkable win for the taxpayer, but it seems like it hinged on a very specific, maybe fortunate, set of facts, particularly the complete absence of formal documentation, which allowed the court to disregard Section 385C, and the court's willingness to let the taxpayer argue substance over their own flawed form. This is definitely not a recommended planning strategy, is it?
Absolutely not. Relying on being able to retroactively argue against your own bad records is tax planning by wishful thinking. The real lesson from Fry is the inverse. Proactively structure your intercompany financing with the correct substance and form from the very beginning.
So what does that look like practically? If one related entity needs cash from another and repayment is genuinely questionable from the start.
Avoid the temptation to just book it as an intercompany loan receivable payable if it doesn't walk and talk like real debt. Instead, structure it properly as a proactive capital infusion. The owner should formally receive a distribution from the profitable lending entity, making sure basis and AAA accounts are sufficient, followed immediately by a separate, documented capital contribution of those funds into the debtor entity that needs the cash. This aligns the form precisely with the economic substance that Fry's estate had to fight tooth and nail to achieve retroactively in court. Document it correctly up front.
That makes sense. But what if a business owner listening right now already has millions in poorly documented, maybe years-old intercompany debt sitting on the books between related entities? How do they clean up that pre-existing mess, especially if repayment is looking unlikely?
That's a common problem. You need to execute a formal cleanup strategy, one that mirrors the substance the Fry Court recognized. This often involves the lending entity formally distributing the intercompany loan receivable, which is an asset on its books, up to the common shareholder.
Okay, so the shareholder now personally owns the debt claim against the other company.
Exactly. Then, in a second, distinct step, the shareholder formally contributes that receivable down into the capital of the debtor company. This effectively cancels the debt at the corporate level by merging the debtor and creditor interest via the shareholder and converts it into equity basis for the shareholder in the debtor company.
But that sounds like it could have its own tax consequences.
It absolutely can. Before undertaking a cleanup like this, meticulous legal documentation must be prepared for both steps. And critically, all S-corporation basis calculations, including the impact on the accumulated adjustments account, AAA, and any potential corporate-level earnings and profits must be finalized beforehand to ensure the distribution of the receivable itself doesn't trigger unintended tax consequences for the shareholder or the distributing S-corp. It needs careful planning. Hashtag tags tag 6.2, the role of guarantees.
Okay, one last area. If a member is hesitant to make a direct loan to their LLC, maybe because of all the compliance hurdles we've discussed with interest and documentation, what about the alternative? What if the member simply guarantees the LLC's debt to a third-party bank?
A guarantee is a very common alternative structure. If a member guarantees the LLC's debt, and later the LLC defaults and the member is actually forced to pay the bank on that guarantee.
What happens then?
That payment is generally treated for tax purposes as creating a worthless debt owed to the member by the LLC. For most individual taxpayers who aren't in the business of making loans, this typically results in a non-business bad debt deduction.
Which is treated as a short-term capital loss. Right. Still useful, but maybe not as good as an ordinary loss.
Correct. It's generally a capital loss subject to capital loss limitations.
And what must the taxpayer prove to successfully claim even that bad debt deduction when they pay on a guarantee?
They have to satisfy 3 strict requirements. First, they must prove the guarantee agreement was entered into with a legitimate profit or business motive, not just as an accommodation or gift to the company. Usually protecting their investment in the LLC suffices. Second, there must have been an enforceable legal duty for them to make the payment to the third-party creditor. And third, crucially, the guarantee agreement must have been entered into before the underlying debt became worthless. You can't guarantee a debt that's already known to be uncollectible.
Is there a way to strengthen the argument that it was entered into for business reasons?
Yes. To eliminate any doubt about whether reasonable consideration was received by the guarantor for taking on that risk, we highly recommend documenting and actually charging the LLC a formal guarantee fee, even if it's a relatively modest amount. Receiving a fee clearly establishes the business nature of the guarantee.
So, after diving deep into all these rules, what does this all really mean for you, the listener? I think the existence of complex rules like Section 7872 makes one thing crystal clear. The IRS mandates interest on most related party loans, and ignoring this obligation simply isn't an option, regardless of whether the official AFRs seem low or the dollar amounts feel minor in the grand scheme of things.
That's right. And while the Byzantine interactions of Section 7872 and Section 267 certainly create complex basis tracking headaches and potential timing mismatches, frankly, those are relatively minor administrative worries compared to the much larger existential risk of recharacterization if you ignore the rules entirely.
That risk the nuclear option, as you called it, really seems like the ultimate lesson here today.
It is. Failure to comply with the basic documentation and interest requirements invites not just back taxes, interest, and penalties on the imputed interest itself, but the far more damaging reclassification of your entire loan into potentially a taxable dividend or distribution. That can lead to immediate, substantial, and completely unforeseen income recognition for the owner, the denial of crucial loss deductions, or even, in the S corporation context, the catastrophic disqualification of the S election. And remember that seemingly low $10,000 de minimis threshold for below-market loans. It's a tripwire that even very small business owners cannot afford to ignore.
Okay, and here's a final provocative thought for you to consider, building on that incredible estate of Fry case. The case certainly demonstrated that, yes, while the courts can, in rare circumstances, allow a highly sophisticated taxpayer, usually armed with highly skilled legal counsel, to retroactively correct the economic substance of a transaction against their own company's poorly reported form. Relying on that kind of judicial generosity is pure high-stakes gambling. It is not a strategy. The IRS has every tool necessary, from the imputed interest rules of Section 7872 to the debt-equity factors applied in Fry, to the constructive dividend doctrines from Wilcoff and McLemore, to dismantle poorly documented or non-arm's length related party transactions. The real practical lesson for every business owner isn't how to win a fight like Fry after the fact. It's that your form must follow economic substance from day one, or you are virtually guaranteed to face administrative scrutiny and potentially devastating tax outcomes down the road. Document it right, or risk the consequences.